I would say that the parts of this that make up the CLO have to be investment grade. And what really makes them safer is the originators of the CLO can pick and choose what is in it. Like a CMBS, once you market that out, what is made up of that piece of sausage, that is set, that is fixed, that cannot change. But the CLO, when they could actually like remove an asset from the security and replace it with another asset. And that makes it much more safer because, and there's also protections where if something in the CLO, if a property within the CLO it goes, it defaults, it no longer is paying, there's like a, how should I explain it? There's kind of like a safety mechanism that stops the flow at that point, and the bondholders get paid back right away from whatever is left, and the sponsor, they get it last. It's basically, there's safety mechanisms within the CLO that protect investors a bit.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show at youtube.com/GowerCrowd and on all major podcast channels. Welcome to today's episode. My guest today is Brian Pascus, who is finance reporter at Commercial Observer. Brian wrote a very interesting and very detailed article on the distinction between CMBS and CLO type finance. I'll include a link to that article on the podcast page at GowerCrowd.com. So I asked Brian if he would join me today to talk about what are the differences between CLO and CMBS and what is the impact of what has been happening with interest rate increases over the last couple of years on these two financial sources for commercial real estate investors across all asset classes. Brian gets into some considerable detail about the differences between these two types of finance, and he explains very clearly what the differences are and what the impact is of rising interest rates over the last couple of years, as well as talking about what the market is like today and where he thinks it is going. And he also talks about what is the single most important thing in the market at the moment, in finance, commercial real estate finance, that will bring the market back to some semblance of normality. If you want to know more about Brian, go to the podcast page at GowerCrowd.com. And while you're there, be sure to sign up for our newsletter. You'll see a big red subscribe button there somewhere. And when you click on that link, you'll also see some of the other people who are subscribers to our newsletter. So go ahead and click on the subscribe button. The newsletter comes out once a week. It's very detailed. It includes links to all the major coverage from the last week, as well as some commentary. And we often include some educational content there as well. Usually it's free and you can always unsubscribe. So it's all there at GowerCrowd.com, where you can find more information on Brian. I'll also include, as I mentioned, I'll also include a link to the article that he wrote on CLO and CMBS while you are there. Okay, let's move on to my conversation with Brian Pascus, who is finance reporter at Commercial Observer. Brian, thank you so much for joining me. It's a real pleasure to meet you. I really appreciate your flexibility as well on the time today.
Of course. Thank you, Dr. Gower. Happy to be here.
So let's jump straight into it. You wrote an article in Commercial Observer, Hits to CMBS and CLOs are bad news for commercial real estate financing. So I'll tell you what, why don't we start at the very top? It actually isn't where your article started, but what are CLOs, what is CMBS, and how are they different?
All right. Well, I'll preface this by saying that CLOs and CMBS is arguably one of the most complex elements of the commercial real estate finance world, if not the most. So I'll do my best to explain it as I understand it. So the first thing you got to understand about CMBS, which means commercial mortgage-backed securities, and CLOs, which are collateralized loan obligations, is that these are just securities. Okay, these are securities that banks and other lenders like debt funds and private equity groups, they make loans and they securitize those loans into bonds that they sell off to investors. And those bonds that they create are either CMBS or CLOs. And that allows them, instead of holding the loan that they make to a borrower on their books just to sit there, they put these loans into securities. They chop them up like pieces of sausage and they mix them together and they sell that bond or security to investors. So now they're getting a steady stream of money back from the investors, but the investors, what they get out of it is they're getting the payments that these different properties that back the loans that are in these securities, they are getting different returns on those depending on where they invest. So I might not have explained that well, but I'll go through them individually. So a commercial mortgage-backed security typically consists, it can either be a conduit CMBS or a SASB, that's single asset, single borrower CMBS. So the single asset, single borrower, think of it like One Vanderbilt. Okay, this is the premier office building in New York City. That's going to be a single asset, single borrower commercial mortgage-backed security, where that single asset, the massive office tower, is what is backing the commercial mortgage-backed security loan, that all those payments that go into that office building, those are going to be turned into a bond that is then sold by the single borrower to the market. That's the SASB CMBS. Now, more typical CMBS are conduit loans, conduit CMBS. Those encompass all sorts of properties. Typically, a recent CMBS we reported about had like 40 different properties in it. It could have like 10 hotels. It could have a couple retail outlet malls. It could have multiple office buildings and some apartment buildings. That CMBS security, and they're typically quite, expensive. They're like 800 millions. Some are, $1.5 billion, $2 billion. These are sold to investors who then invest into the different tranches, is what they're called. So you're going to have like 12 different tranches of risk that investors will invest in. And it's usually for like 5 to 10 years. So it's a long time for the lifetime of the CMBS. The collateralized loan obligation, the CLO, that's a little different. So it's different in a couple ways, but it's similar. It's also security. It's also something that is used to generate returns from investors in a steady stream of capital. But it's more of a credit facility. So those originators, those lenders, which are banks, but they're also usually private equity funds, debt funds, alternative lenders, they hold on to a piece of that. So the CMBS is different, where the lender, the originator, the bank, securitizes the product and sells it to the market. They no longer have it on their balance sheet. It's gone. The CLO is kept. A portion of that is kept on the originators and on the lender's balance sheet for good reason. So they have some skin in the game. And these are typically more investment grade assets. It's a floating rate security, whereas the CMBS is fixed rate. And these right now are largely made up of multifamily properties. Within there, these CLO securities are typically backed by multifamily properties, and they're usually a little bit safer, but they're both relatively safe. But when they go bad, it's very complex. So that's kind of the introduction to CMBS and CLO. I probably didn't explain it very well, but I also don't explain very well to myself when I'm trying to make sense of it.
Yeah, and I usually find that I understand things better when I try and articulate them to somebody else. But SASBs, just to go through a couple of quick points here, SASB cannot be tranched because it's a single asset, correct?
Well, it can be. You could tranche the different credit risks within the asset. Like different parts of because a massive building is going to have multiple different parts of its capital stack, and there's going to be multiple different parts of the debt that is and how the building itself is constructed with the type of tenants and stuff. So that can be tranched as well
by the tenant credit, essentially.
It's by the originators who are doing the deal with the borrower. Yeah, they figure out how to construct it.
And both CLOs and CMBS are rated by the rating agencies.
Yes, they're rated and they are analyzed very thoroughly. The different levels within a CMBS, as I said, there's like 12 to 15 different investment grade portions of the bond that people buy into. So the less risky portion makes up a majority of the loan that people can invest in. The more risky portion of the security, investors, can get higher returns on that, but it's more likely to fail. That part of the CMBS is less likely to be paid off by the tenants who are giving those rents into the property that is backing the security.
And you talked about selling to investors. Who are the investors?
The investors are kind of the faceless, nameless, market forces that are out there. A lot of them are, pension funds and high net worth individual groups, and there's different types of investors at banks. It's just folks who are playing the market and are looking to make money off of the CMBS and CLO markets. It's kind of that faceless capitalism machine that exists, but we rarely see it.
And you mentioned that CLOs are safer. In what way are CLOs safer than CMBS?
Well, I would say that the parts of this that make up the CLO have to be investment grade. And what really makes them safer is the originators of the CLO can pick and choose what is in it. Like a CMBS, once you market that out, what is made up of that piece of sausage, that is set, that is fixed, that cannot change. But the CLO, when they could actually like remove an asset from the security and replace it with another asset. And that makes it much more safer because, and there's also protections where if something in the CLO, if a property within the CLO it goes, it defaults, it no longer is paying, there's like a, how should I explain it? There's kind of like a safety mechanism that stops the flow at that point, and the bondholders get paid back right away from whatever is left, and the sponsor, they get it last. It's basically, there's safety mechanisms within the CLO that protect investors a bit. What makes it safer is that the CMBS, when there's defaults, that creates a very complex dance called special servicing.
Right.
And when the CMBS security and the properties that are backing the security, either one or many within it, go into default, that's a huge, huge problem because special servicing is very, very complex. And it takes a long time to work out how to, stabilize the properties that are within the CMBS. So for investors within CMBS, it's a pain in the ass, to pardon my French. It's difficult. It takes a while, and there's workouts. So usually with the CMBS, there's kind of like a game of chicken between the special servicer who's representing the bondholders of the CMBS security and the sponsor who has taken out the loan for the building that is backing the security. Both sides don't really want to have it go into default, but you have to kind of play the game to figure out how are we going to work this out that works for both sides.
And have you seen over the last few years differences in the kinds of terms offered on CLO loans versus terms offered on CMBS loans, or in terms of the underwriting standards for each of those?
Well, the biggest change that's happened over the last 18 months, essentially, is the interest rates have gone much higher in our economy. So the CLO is pegged against the secured overnight financing rate, the SOFR floating. That is the standard rate that banks use to lend with each other. It's the interbank lending rate. It used to be LIBOR, but there was a scandal. Now we have SOFR, and that has moved. I believe it was at like 2.28% a year ago. It's at 5.31% today. So it's basically almost tripled. And the cost of floating rate debt has thus increased significantly, which has made CLOs a lot less attractive. I think you had $18 billion of CLO issuance in 2019. This year, I believe we're barely at 1.2 billion. There's only been 9 CLO originations in the entire year, and it's now October 31st. It's almost November. So that's been an issue. And the exact same thing has happened on the CMBS front. But the CMBS front is even more technical, and I'll get into it in 1 second. CMBS is pegged against the 10-year treasury. So the 10-year treasury, which for much of the last, I think between like March 2020 and July 2022 was less than 1%. So the 10-year treasury yield today is now at 5%. It's gone astronomically high, and that's impacted all sorts of elements of our economy, especially mortgage rates, which are now at 8% because of the increase in the 10-year treasury yield. When the 10-year treasury yield goes up, it's usually because investors have less faith in the stability of the U.S. economy, because that treasury yield is basically what investors consider the U.S. debt. The U.S. The word is our bond. The U.S. note to be worth. So there's a little bit more concern about the economy, and that's why yields are spiking, because there's a lot less interest in holding U.S. debt. Now, the CMBS, and by the way, just even saying this right now is reminding me how technical and obtuse all is. So I'm sure I put a few people to sleep, but this is just how it is. This is the market that commercial real estate finance trades in and works in. CMBS issuance has gone down significantly because the 10-year treasury yield has spiked, which means those originators who create the CMBS bond, they need to make their money back when they're securitizing this to the market. So if the 10-year treasury is at 5%, they got to give themselves 350, 400 basis point spreads. That means they need to bring that out to investors at 8, 9%. That's not very palatable for investors, which is why issuance is so low, because there is less appetite for people to invest in that market. And the exact same thing is happening with CLOs. So when interest rates rise, it's crippling to commercial real estate. Even basic commercial real estate, non-securitized lending, is down significantly. Lenders have left the market, and the amount of deals that are being done has left the market because the cost of capital is so much that people are sitting out and waiting for interest rates to go down or stabilize. And because they haven't stabilized in almost 2 years, that there's a lack of appetite to start new projects.
Let's get back. Yeah, go ahead.
There's also one other very important point to understand about CMBS. So many CMBS deals were made in 2013, 2014, 2015. Those are usually 10-year deals. So that when you hear about the idea of maturities occurring in the commercial real estate market, that's because these 10-year CMBS deals were made in 2013, and now it's 2023, it's going to be 2024, and so on. That's when they mature, and they're going to have a lot harder time paying off at maturity, because net operating income standards have changed so much as more and more people have left the office world. Less people are renting space, in different parts of these multiple asset classes have changed as a result of COVID-19.
And CLOs are much more recent, aren't they? The bulk of the distressed CLOs are within the last 3 years.
It's within the last 3 years, and that, again, is tied to the fact that so many of them are using multifamily properties to back the security. And the multifamily asset class has been hit really hard because so many of those deals were financed with floating rate debt. Floating rate debt is great when interest rates are low and they stay low, as they had for 2008 until 2022. Right. Effectively, I don't think they rose above 2.25% between 2008 and 2022. Well, they've gone up to 5.5% today, and they did that very quickly within 18 months. That's terrible for anyone who uses floating rate debt to finance their multifamily investments or their construction or their properties. So that's why the CLO marketplace is dried up, because multifamily used to be kind of dependable. You're going to get rents. There's fixed cap rate increases that you could purchase to protect you a little bit. Well, that whole asset class has been totally thrown off, especially by cap rate compression, which has really shown who can sink or swim in the multifamily space.
Actually, cap rate expansion is what you mean. Over the last few years, prices have gone down, right? Cap rates have gone up.
Yes.
Cap rate expansion.
There's been cap rate expansion, and I think what I meant to say is that previously they were saved by cap rate compression.
Right.
So thank you. That's why you're the PhD. And
that's all right. I know how to ask questions that I don't understand. That's basically all it is. Just one question though, before we move on to something else. Underwriting standards. So was there a difference between the lender standards for underwriting CMBS versus lender standards for underwriting CLOs?
That's a good question, and I don't know how to answer that because that's not something that came up in many of the interviews I've had about this. So I don't want to say anything I don't know. I would have to say though that I think underwriting standards have improved tremendously since the 2008 financial crisis, and I know that no one wants to be holding something that they don't know what is in it and what exists. And that's one of the reasons why the financial crisis was such a problem, is that underwriting standards were so lax, especially for our MBS, residential mortgage-backed securities, which really caused the whole crisis. So I think when people hear, CMBS, they might get triggered by the MBS and think, oh, this is like another crisis. It's a lot different with the commercial real estate mortgage-backed security because of the complexities that go into making a single commercial real estate deal versus a housing deal, residential housing deal. That's much easier for someone to pretend that they have income and they don't have. And that creates issues with underwriting standards in the residential space. In the commercial space, that's big time corporate finance. It's a little bit tougher.
So when you talk about CLO underwrite or lenders being able to bring assets in and out of a CLO,
yeah,
that implies that they have assets that are good to replace the bad. With as much CLO or as much multifamily distress as there is that going to cause problems for CLO lenders where the entire, huge proportions of their portfolios are distressed, that they don't how do you bring a good loan in if you don't have one? How do you replace it if 90% of your lending is struggling?
It's not clear, how widespread the distress is in multifamily. There's typically been some distress in some of these smile states. We've heard a lot of issues going on in Texas and Arizona where there was some overbuilding and then there was some syndication where a lot of these firms that might not have had the most honest business plans took advantage of individual investors, and now they're in trouble because they were marketing, bad assets. It depends. Typically, there probably will be some distress for some of these lenders in regards to the multifamily space, but multifamily is not the same in every state. There's a wide gamut of it. There's a wide, array of strengths and weaknesses in the multifamily space, depending on markets. And, these securities, these CLO securities are usually very well diversified, where they're not just saying, oh, we're going to be a Arizona multifamily CLO or New York City multifamily CLO. There's all sorts of ways that these people who come up with this stuff kind of hedge their bets, so to speak. And there is a wide array of different types of properties and loans behind those properties that they can pick and choose to move out of. And what also helps them is these securities are typically shorter duration. I believe they're typically like 18 to 36 months. They're not like the 10-year CMBS. And we've even seen changes in the CMBS duration of structure where instead of being a 10-year CMBS, you're seeing a lot of 5-year CMBS to take into account the fact that the equation has really changed for office and retail over the last few years.
I'm totally sensitive to your time, so you just give me a nod when you want me to wrap up. I'm going to ask you a question I want to pick up on. You talked about individual investors and some of these sponsors borrowing from raising money from individual investors. Can you drill down on that idea a little bit more, what you were talking about?
Well, that's typically in the multifamily space with the syndication, where you have a company, let's call it just company A, and it's in Houston, and they basically, want to buy up property, and they do so, but they do it where they convince mom and pops to front them some of that investment money, where they're going to get a piece of that pie when the property's rented and people go into it, and they typically do it under the auspices of that they're going to flip the property down the line for even more money, and then them and their investors are going to get a lot. the issue where I think this is running into trouble, and I'm not an expert in this by any means, I haven't really reported on it, this is just from my own conversations, is, I believe that now that floating rate debt has caused some issues because interest rates have risen. A lot of these properties are worth less than they were marketed to investors as, and they're having trouble filling them, and they're thus having trouble flipping them. So the big conglomeration, the big company that has convinced mom and pops to front them the money to do these deals, they're hurting, of course. But the people who are really hurting are those who put their life savings into these deals and were convinced that this is a safe asset, that this will work great for you, that you're going to triple your return.
Right. They're
left holding the bag. And that's why, Americans, we've seen the same thing play out for over 100 years. It goes back to Melville's confidence man. If someone is telling you something that's too good to be true, it is, and you're going to get burned. And if you think you can make just a quick buck, especially if you're just some investor, living out of your house, doing it on the side, you're going to get hurt, just like all those people got hurt in the crypto space. And that's kind of what you see in the syndication world, is you got fast talking, fast moving salesmen who have a company and they have a corporation and they market it to, Jack and Jane, and they take what they can get from the little guy and they help themselves. And that's just how capitalism has worked in this society for a while. And people should just, try their best to do their homework so they don't get taken advantage of.
What proportion do you suppose of CLO lending? This might be an unfair question, but what proportion of CLO lending has been to this kind of syndicator that you're describing now?
I can't say. I don't know. I'm not an expert in that realm. I think it's a portion, and I just cannot tell you a number,
specific number. All right, so let's move on to predictions. I know you're going to love to do this, but don't worry, we won't hold you to it. If you get it right, we'll come back and we'll talk about it. And if you don't, we won't bother. Right?
Sure.
But so you talked about stabilizing, and you described the new metrics essentially of this market: increased insurance rates, flattening or reducing rental rates, increased interest, et cetera, et cetera. So what's going on in the market now for CMBS and CLO, and how do you think it's going to roll out over the next few months?
Well, not much is happening. Issuance is down significantly. I think it's down something like 73% between the two of them. CLO is much less active than CMBS. Conduit CMBS is more active than SASB CMBS, but they're both, down quite a bit. You're not going to see much change until Jerome Powell and the Federal Reserve give us some indication where interest rates will remain. He's kept them at around 5.5% now for a few months, but he's already hinted that they might go up to 6% in order to fight inflation. As long as inflation is still causing problems for the American economy, Jerome Powell is going to keep raising rates. And as long as he keeps raising rates, the commercial real estate industry is going to be in a state of paralysis. And that's just how it is. This is the game, and interest rates are everything to commercial real estate. It is how debt powers that economy, and the cost of debt is significantly more than it was before. And it's causing issues with refinancing, where people who took out loans and took out debt at 2-3% interest rates are now being asked to refinance at maturity much higher, and they don't have the money and they don't have the net operating income, because people are no longer renting office buildings the way they did. And people, there's an overabundance of supply in multifamily, and retail's obviously been hurt. So, and then hospitality, of course, is recovering from COVID. And industrial, while that's a safer asset class, that's in some ways being overbuilt, and it's not, frankly, the most exciting thing for investors. So you're not going to see much activity, I would imagine, until there's a sense of confidence that the Fed will keep interest rates at a certain point and telegraph that point for a long period of time.
Yeah, that's a very important point. And plus, buyers anyway of these underwater loans can't get debt either, because the debt markets have basically frozen up. So the most important factor driving where the market's going to go is predictability, would you say?
Yes. Capital markets, investors, no one likes unpredictability. They want to know where things are. And frankly, a lot of capital markets professionals and real estate professionals were spoiled for 15 years when the Fed basically kept interest rates low, less than 2% for that time period, and didn't really change anything. That great era of quantitative easing. And yeah, that really, I think, created a false sense of understanding for many professionals, especially those who first got into the industry in that time period, that's just how it is. But it's not. Typically the 10-year Treasury, its average has been around 5.3%, where it is today. That's over 50 years. It's been around that point. So older capital markets professionals I've spoken to, they kind of laugh and snicker at these younger folks who expected this world of low interest rates to go on forever. And that's not the case. Paul Volcker brought the federal funds rate, the benchmark rate, I think brought it to 18% in 1982. 18% is a lot higher than the 2.25% Jerome Powell had it at before he started raising. So you can understand how unstable it is for many investors and many real estate professionals.
I have to say, I'm embarrassed to tell you, I do remember the early 1980s is when I arrived here. And I remember actually getting, I'm pretty sure I got 12% on deposit at the bank. That was the interest that they were paying on my deposit. It may have been 10 or 12.
Yeah.
It was a totally different world. All right. Well, one last question, and then we'll sign off. How long? What do you think of going into 24? What's your view on how long it's going to take to stabilize?
I don't know, because it's funny. The Federal Reserve tells you that we're taming inflation. All these indicators are it's okay, and I go grocery shopping, and other people I know do, and it doesn't feel like inflation's gotten much better. And furthermore, I think oftentimes the Federal Reserve, when they're looking at inflation, they're not recognizing the fact that there's other types of inflation beyond just what an apple costs. There's the inflation of how much it costs to get an education and go to college or graduate school. Right. There's the inflation of how much it costs to get a house. Okay. And then probably the most inflation we've seen in our lives is how much it costs to go to the doctor and healthcare. So everybody is feeling the effects of that type of inflation, and it's changing the economy, and it's changing how we live. It's changing whether we buy houses, whether we start families. It changes whether we go to school. And I think that until our political class and people like Jerome Powell get a handle on that inflation, you're going to see changing consumer behavior that's going to obviously have an impact on capital markets across the wider economy for probably much of 2024. But we'll see. It's an election year, so anything can happen.
Brian Pascus, finance reporter at Commercial Observer. Thank you so much for joining me today.
Thanks, Dr. Gower, for having me. Appreciate it.
All right, that was Brian Pascus, finance reporter at Commercial Observer. CLO and CMBS. Oh my goodness. He didn't discuss it, but it does give me flashbacks to what happened in residential real estate during the global financial crisis. Only time will tell. Thank you for joining me. Brian, thank you so much for joining me. What a pleasure meeting you. And thanks so much for your flexibility on timing, particularly today. That extra 15 minutes that you afforded me was very helpful. And thank you also, dear viewers. Really appreciate you tuning in today. As I mentioned, please do go to the podcast page at gowercrowd.com. You find out more about Brian. I'll put a link into the article there that he wrote for Commercial Observer. And while you're there, if you've not done so already, do please subscribe to our newsletter. It comes out once a week, and it covers everything you need to know about what's going on in commercial real estate syndication over the last week. All right, that's it. I'll see you next time. And for now, this is Adam Gower signing off.